The Lucid Motors stock has been the topic of many conversations lately, and in today's video we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is still very volatile at the moment, we should be mindful about which positions we choose, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Over the past few days, the price action of Lucid has brought the stock to around $13.86 before stabilizing around $18.96. Lucid share has had an interesting month so far. The company's share has first dipped below its historic support level, something that should be very significant and which should have also triggered additional tumbling downward from here. Something that happened on multiple occasions for many other companies, like Virgin Galactic's. However, the price action was able to later bottom from there and bounce back. Now, there are two possible explanations for this. The first one is that Lucid, just like the rest of the sector, moves along the risk appetite of the capital flowing in or out. This can explain why many titles bottomed out almost at the same time and bounced back to various degrees ever since. The second explanation has to do with the stock itself. Now, obviously, there is no scientific backing for this logic, but the future performance of a stock often depends on its historical performances, in the sense that the support and resistance levels do play a role in the future price action, because it plays a key role in molding people's collective psyche. It's a little message suggesting that because the stock was able to hold the ground at a specific level before, it would also be able to hold the ground this time again. And just like a self-fulfilling prophecy, the market would react in that regard. Obviously, it doesn't always work that way, but it's something that is sufficiently significant that at the very least, for people selling the stock at the very moment, or even those with an overall bearish look on Lucid, would prefer to wait before continuing selling its shares at that point in time, and more importantly, at that price level. Looking forward, I believe that the stock will begin to recover slowly over the next couple of months, assuming that the sector itself has seen the worst of the sell-offs behind it. Now, let's also take a look at the technicals of the stock. The trading volume of Lucid Motors has recently been 13 million shares versus an average volume of 24 million shares. Over the previous 52-week period, the price fluctuated between $13.25 and $57.75. The trading volume is often a metric that can tell you how many shares are being exchanging hands and whether there's a lot of activities and attention on the stock. It gives you a first-hand idea about the popularity of the company. We can also use it to compare with the average volume, which can tell us if the company is enjoying additional marginal momentum to reverse its current trend or to break through the resistance. Even when the current volume is lower than the average, it is an interesting indication because it may signify that a trend reversal can happen soon. The market cap of Lucid Motors is currently at $32 billion versus an enterprise value of $39 billion. To put simply, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for its current assets minus the debts. It's worth mentioning that one of the most significant assets for many growth companies is the intangibles. Intangibles are not equipment or inventory, but they are the promises that this company can grow significantly in the future, such as pledges for contracts, charismatic and competent management, or blueprints and schematics. For startups, most of these valuations are based off the intangible, which may be valued in more favorable market conditions. In concrete terms, this means that there can be a huge difference between the market cap and the enterprise value, giving a false impression to market participants that the company is trading at a discount. It's only trading below its book value, but doesn't mean that the company itself is necessarily undervalued. It's also possible that the company itself was overvalued in the first place, and it has been deflated ever since. As we compare the current price to the historical price fluctuations, the stock is 43% higher than the 1-month low, 43% higher than the 12-week low and 43% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment about where the stock price is likely going to go next, the implied volatility is 88% versus a historical volatility of 103%. The put-call volume ratio is currently at 0.62. It is normal for many stocks to also tend to have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 111,000 contracts a day versus the 30-day average of 105,000. In terms of open interest, the most recent volume of open interest is 1.2 million contracts versus the 30-day average of 1.3 million. The option contract is a derivative from the underlying security, giving participants the possibility to have the right to either buy or sell the security at a predetermined strike price. Buying the contract would give you the right, and selling the contract would give you premiums with obligations to execute and satisfy the obligations if the counterparty chooses to do so. It's often said that you can evaluate the likelihood of your scenario based on the opposite of what people are buying for options. For example, if there's a lot of put options on the market, maybe the stock may go up. Or if people are buying call options, maybe there will be a reversal in the making. So the reasoning behind that theory is quite simple. Most options will expire, worthless. In terms of shareholder structure, institutional shareholders own 70% of its outstanding shares. The biggest shareholders include Vanguard, BlackRock, and Franklin Resources. It's relevant to understand the shareholder composition of a company, as this can help us to determine if you should hold the stock long-term or to trade it short-term. If the stock is mainly held by retail traders, this may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be between 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. This is obviously subject to a lot of exceptions, since many great titles are also mostly held by retail investors and not the institutional ones, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit the share price falls lower. Sometimes when there are significant short interest in the making, this can be a sign that there's something organized from the institutions going on, such as what happened with GameStop and AMC. The current short interest is 24% of the total float, and 60% of these happen outside of the public exchanges. Usually, if the short interest is above 15% of the volume, with a significant chunk of it coming out of the dark pools, this may suggest that there are potentials for a short squeeze, which is the case for Lucid at the moment, in my opinion. Now, my recommendation for Lucid is to buy its shares at the current price point and to leave at least half of your allocation for later for additional pullbacks or retracements, or if the stock has been confirmed to reverse its sell-off trend. I believe that Lucid has enough intrinsic value to attract long-term investors and would also invite you to put more emphasis on the long term instead of the quick gains. I would recommend to commit between 3 to 5% of your portfolio's capital on Lucid, and would also recommend to split the allocation in batches of 10 or 20% at a time so that you can purchase more in further retracements. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance. since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.